Welcome to Talk Tickers. We're your deep dive, taking you right inside the latest earnings calls, breaking down the numbers, the narratives.
That's true. Yes, sir.
Today, we're unpacking A10 Networks, that's ticker A10N, and their third quarter 2025 results. They released those after the bell on November 4th.
And our job here really is to cut through all that transcript jargon. We want to pull out the poor stuff, the operational gears turning, how disciplined they are financially, and, the strategic hints about where they're headed.
Especially A10, right. They're in that space of application delivery, security, stuff that's vital for big data centers.
Exactly. And increasingly absolutely critical for these massive AI buildouts we're seeing everywhere.
That context is super important because, look, this was a clean quarter on paper. You look at the numbers, it screams, disciplined execution.
Definitely.
But then the stock kind of just sat there, right?
Yeah.
Near that $17, $18 mark.
Yeah.
It felt like the good news on operations got canceled out by, everything else going on globally.
That's the tension, isn't it? That's what we need to unpack for you. The market clearly saw the execution, liked it, but it's still hesitant. Nervous about the macro environment, nervous about whether this growth is, sustainable.
Okay, so let's lay the foundation. Start with those headline numbers that everyone looks at first.
Yeah.
What do they actually report?
Right, top line. Revenue came in at $74.7 million.
Okay, $74.7 million, and that's up year over year.
Yep. Up 11.9% year over year. And importantly, that beat the consensus estimate, what analysts were expecting, by about 6%. They were looking for closer to $70.7 million.
So a solid beat on revenue. How did that translate down to profit, the bottom line?
It flowed through pretty well. Non-GAAP earnings per share, or EPS, landed at 23 cents.
23 cents, and the street was looking for...
Around 21 cents, so another beat there. GAAP EPS, the official accounting number, was 0.17 cents, which actually matched the prior year.
Okay, so beats on top and bottom line. But you mentioned something more interesting there, the operational leverage.
Yeah, this is where it gets interesting beyond just the beats. It wasn't just that they sold more, it's how they sold it profitably. Their non-GAAP gross margin, basically, what's left after the cost of the goods they sold, held really strong at 80.7%.
Wow, over 80% gross margin that's quite healthy.
It really is. And even better, the non-GAAP operating margin, that's profit after operating costs like R&D, sales, admin, it actually expanded compared to last year, came in at 24.7%.
So higher revenue and wider operating margin, that's the operational leverage signal you were talking about.
Exactly. For anyone tracking profitability, that margin expansion, that's the clearest sign their business model is clicking. They're getting more efficient. They're turning those sales dollars into actual operating profit more effectively, even while they're investing.
Okay, so the model's showing leverage. Investors like seeing that. Let's peek under the hood then. What about the mix of that revenue, products versus services?
Right. This breakdown tells a story about the future. Product revenue, selling the actual hardware boxes and software licenses, was really the star. $43.1 million. That's up a huge 17% year over year.
17% product growth. Okay. And services, that's usually the recurring stuff, right? Support, maintenance.
Correct. Services revenue was $31.6 million. That grew too, but more modestly, 6% year over year.
So that 17% product growth is pretty significant. Management probably sees that as a good sign for the future.
Oh, absolutely. They explicitly call product revenue a leading indicator for services. Think about it. Every time they sell one of those boxes, it almost always comes with a support contract.
Right, which renews typically annually.
Exactly. So a surge in product sales now, like that 17% jump, should mean we see an acceleration in that stickier, often higher margin services revenue down the road, maybe, a few quarters out as those contracts kick in and renew.
You buy the box now, you pay for the support later, and that support keeps coming. Makes sense.
And this ties right into their big strategic push too, security. They mentioned that revenue from their security solutions actually went above their long-term target. It was over 65% of total revenue in Q3.
So that confirms they're playing where the demand really is cybersecurity, high-performance networking for demanding applications.
Precisely. Now, where is all this growth coming from geographically? Because that's also a really key part of the story this quarter.
Okay, where is the engine running hot?
The Americas. Simple as that. The Americas region accounted for a whopping 65% of their global revenue. It basically carried the quarter.
65% from the Americas.
Yeah.
Wow. So strength there must have been offsetting weakness somewhere else.
That's exactly what happened. They pointed specifically to enterprise customers in the Americas. Growth there on a trailing 12-month basis was actually outpacing the company overall, like 25% growth. And the driver, big investments in AI infrastructure.
The AI tailwind we keep hearing about. So US-based AI builds are pulling A10 along strongly.
Very strongly. And that strength was enough to balance out the headwinds they saw internationally, where companies are just being more cautious with their spending because of the macro uncertainty.
Okay, but 65% from one region, driven by AI, which, as you said, is often big, chunky deals. Doesn't that raise concerns about concentration? Relying too much on a few things.
That's the million-dollar question, isn't it? And yes, management addressed this in the Q&A session on the call. They confirmed it. Right now, that AI benefit is concentrated. It's coming from, quote, a few large customers doing these initial really big AI build-outs.
So great revenue now, but the market sees that concentration and gets nervous.
Exactly. It's a risk factor. The market wants to see A10 prove they can broaden that out, land more AI-related deals across a wider set of customers. That's sort of the next big test for them.
Okay, moving on from revenue drivers to how they're using their cash, capital allocation, share buybacks, dividends.
Yep. They kept the shareholder returns going. They spent $11.0 million buying back their own stock, about 634,000 shares.
At what price did they say?
Yeah, an average price of $17.41 per share, which, interestingly, is right around where the stock has been trading. So they're actively supporting the price in that range.
Dividend.
Steady as she goes. Declared the regular quarterly dividend, $7.06 per share.
Anything else on the balance sheet we should note? Debt.
Yeah, definitely worth mentioning the debt structure. They still have about $60 million left on their share buyback authorization, so they can keep doing that. But the interesting part is their convertible notes. They have $218.5 million outstanding.
Convertible notes. Okay, refresh my memory. Why is that significant here?
It's all about the terms. These notes have an incredibly low interest rate, a coupon of just 2.75%. And crucially, they don't mature. They don't come due until 2030.
2.75% until 2030. In today's rate environment, that's practically free money.
Pretty much. It means they have zero pressure to refinance that debt anytime soon. It gives them enormous financial flexibility to keep buying back shares, fund growth, whatever they need, without worrying about a big debt payment hanging over them. It's a really good position to be in.
Okay, flexible balance sheet, solid returns. But what about the future guidance? Did they give specific numbers for Q4 or the full year?
They stayed away from specific numeric guidance for the next quarter. That's pretty common for them, especially with the global picture still a bit fuzzy.
So what did they say?
They basically reiterated their commitment to hitting a 10% growth trajectory for the full year 2025. The focus message was all about disciplined execution, closing deals into the end of the year. Keep your eye on the long-term plan, essentially.
Got it. So let's pivot to that longer-term plan, the strategy. We touched on AI infrastructure driving America's growth. Can you elaborate a bit more on how A10 fits in there? What's their specific pitch?
Right. So the core idea is you're building this massive AI cluster. You need networks that can handle insane amounts of data, really, really fast, high throughput, super low latency. Plus, you absolutely need to protect it, especially against things like DDoS attacks.
Okay, standard requirements for big compute. Where does A10 come in?
Their pitch is efficiency. They claim their technology, their hardware and software can deliver that necessary performance and security, but using fewer physical devices compared to some competitors.
Fewer boxes. So that connects to the customer's costs.
Directly. It connects straight to total cost of ownership, or TCO. If a customer believes A10 can do the job with, say, 1 or 2 boxes instead of 3 or 4 from someone else, well, that means less upfront cost, less power consumption, less cooling needed, less space in the data center rack, and it's simpler to manage.
So the pitch is performance and efficiency, lowering your overall cost. That's pretty compelling when companies are pouring billions into AI CapEx.
Exactly. It's a strong value proposition in this specific environment.
Okay, makes sense. Now, leadership-wise, this call was also this sort of formal introduction for the new CFO, right? Michelle Caron. She started back in September.
That's right. It was her first earnings call.
What was the takeaway from her remarks? What signals did she send?
Her message was very much aligned with what we've been discussing, focused heavily on operational rigor, driving consistency, predictability. She really emphasized maintaining that financial discipline, the smart capital allocation. We talked about buybacks, managing the balance sheet.
So reinforcing that message of steady, profitable execution.
Precisely. It signals continuity and a focus on the bottom line, on efficiency.
Okay, let's switch gears again. Competition. There was some talk about, let's call it the F5 factor. A key competitor, A10 Networks, Had a well-publicized security issue recently. Did A10 comment on whether that's creating opportunities for them?
They did. Management said yes. Following that incident at F5, they've seen an increased level of interest. More conversations happening with customers who are now actively looking at alternatives, wanting to make sure their own setups are resilient.
So customers are kicking the tires on A10 because of the competitors' problems. That sounds like a big potential win.
It is a potential win, and this is a crucial good. Those conversations don't just flip a switch and turn into revenue overnight.
The sales cycle. How long did they say it takes? What's the timeline investors need to have in mind here?
They were pretty clear on this. The typical sales cycle from having those initial exploratory talks to actually getting signed deals, getting bookings, it's 6 to 9 months.
6 to 9 months. Okay, so that pushes any real benefit from this competitor issue well into 2026, right? We're talking Q2, maybe Q3 of next year before it really shows up in the numbers.
Exactly. It's not an instant boost for this year's results. It's a potential catalyst for next year. And that time frame, that lag, is important.
Yeah, because a lot can happen in 6 to 9 months. There's a risk those conversations fizzle out, or F5 shores up its defenses and customer confidence.
That's absolutely the risk. It's not guaranteed money. A10 needs really strong, consistent sales execution over that entire period to actually capture that market share. It requires patience from investors looking for that catalyst to hit.
Patience seems to be a theme here. It also applies to their longer-term push into the enterprise market, doesn't it? They've been working on that for years. How did they describe their progress there?
Yeah, they use a baseball analogy. When asked about how mature their enterprise sales efforts are, management said they're probably in the third or fourth innings.
Third or fourth inning. So like halfway there, maybe a bit less.
Something like that. It signals progress, definitely. They're on the field, they're playing the game. But it also signals they're not done building it out. They still need to get to those later innings, maybe the seventh or eighth.
And getting there means more investment.
Likely, yes. Continuing to invest in specialized sales teams, sales engineers who really understand enterprise needs, broadening their network of channel partners, just building that brand awareness specifically within large enterprises. These things take time. Enterprise sales cycles are long. It's a multi-year journey.
Okay, so execution needed on capturing competitive share, execution needed on maturing the enterprise push. Looking further out then, beyond 2025, did they give any hint about 2026 growth expectations?
They gave some preliminary high-level thoughts. The goal, they said, is to try and sustain growth in the high single-digit range. So think 8 to 10% for 2026.
8 to 10% growth for next year.
That's the aim. But they added the usual caveats. It depends on navigating the macro stuff, tariffs, interest rates, global uncertainty. But critically, the financial goal alongside that is to keep growing EPS, the profit per share, faster than that top-line revenue growth.
Maintaining that margin expansion story, the operational leverage.
Exactly. That's the core financial narrative they want to maintain. Grow the top line steadily, but grow the bottom line even faster through efficiency.
Okay, let's put A10's recent stock performance into some context. You mentioned it was kind of flat after earnings. How has it done over, say, the last year compared to its peers?
Right. Context is useful. Over the past 12 months, A10 stock delivered a total return of about 6.2%, give or take.
Just over 6%. And how does that stack up against maybe a broader cybersecurity benchmark, like the HACK ETF?
Yeah, good comparison. The main cybersecurity ETF, HACK, was up significantly more, somewhere in the low 20% range over that same year.
Okay, so A10 at plus 6% versus the sector ETF at plus 20-something%. That's a pretty noticeable lag.
It is. And that lag definitely puts pressure on management. It signals that while the market sees some good things, it hasn't yet fully bought into A10's growth story compared to the broader security space. They need to execute consistently to close that valuation gap.
Did trading volume tell us anything around earnings?
It was definitely elevated. They usually trade around, say, 610,000 shares a day. Around the earnings release, volume spiked to nearly 1 million shares.
So lots of activity, lots of interest, maybe a bit of a debate playing out in the market between the bulls and the bears.
Seems likely. High volume often means strong opinions on both sides are actively trading the news.
All right. We've covered the results, the strategy, the risks, the outlook. Now let's step into our speculative sandbox for a moment.
The fun part.
The fun part, exactly. But seriously, remember everyone listening, this next bit is purely for discussion, for entertainment. We're just playing with what-ifs based on the data. This is absolutely not financial advice. Don't trade based on this.
Couldn't say it better myself. We're just connecting dots, exploring a potential scenario, nothing more.
Okay, disclaimer delivered. Here's the trade pitch, the idea. What if the market right now is actually underpricing the combined impact of these potential catalysts we've discussed?
Go on.
The stock is sort of stuck near $17, right? Maybe because the market is too focused on the current AI concentration risk, and it's being too impatient about that 6 to 9 month sales cycle for capturing competitor share.
So the idea is that the market isn't looking far enough ahead.
Potentially. So the trade idea would be consider a long position in A10, maybe around this current $17 level. And the bet you're making is on a double catalyst event, hitting sometime around Q2 of 2026.
A double catalyst in Q2 26. Okay, what are the two parts?
Part one, that 6 to 9 month sales cycle we keep talking about, the one related to the F5 opportunity, starts to actually bear fruit. Bookings accelerate, proving they can capture that share and move further into those enterprise innings.
Okay, Catalyst 1 is competitor share capture materializing. What's Catalyst 2?
Catalyst 2. Remember that strong 17% product growth we saw this quarter. By the middle of 2026, that should have fully translated into accelerating services revenue growth as all those new support contracts kick in and start renewing. That boosts overall growth and likely margins even further.
So the product growth leading indicator pays off, boosting the recurring revenue stream.
Exactly. So the bet is that if those two things, the competitive wins landing and the services revenue accelerating hit around the same time in mid-2026, well, that fundamentally changes the growth profile.
And the argument is that such a changed profile would warrant a higher valuation multiple, maybe closer to those faster-growing cybersecurity peers that A10 has been lagging.
That's the thesis. Significant potential upside from the current $17 level if management executes flawlessly on the timelines they themselves laid out for converting interest into deals and product sales into services growth.
It's a scenario built entirely on execution and timing converging perfectly. High potential reward, but definitely relies on things going right over the next year or so.
Absolutely. It's a speculative idea based on connecting their own commentary. Okay, let's pull back from the speculation and wrap this up. What are the main things you, the listener, should take away from this A10 deep dive?
I think number one, it was a clean Q3 beat. Good revenue, good EPS, definitely beat expectations. Number two, clear evidence of margin expansion that operational leverage is working.
Number three, the growth engine right now is the Americas, heavily fueled by concentrated AI infrastructure spending. Watching if that broadens is key.
And number four, there's a clear strategic focus on turning competitor weakness, that F5 factor, into actual enterprise wins, but that's a story for 2026 given the 6 to 9 month timeline.
So the big picture challenge for A10 is really moving beyond just being a company that posts solid quarters, right? It's about convincing the market they have a durable, resilient growth story.
Exactly. Can they keep expanding that security part of their business? Can they fully capitalize on this AI wave beyond just a few big customers? If they nail both of those,
Then maybe that goal of 10% top-line growth with even faster EPS growth starts to look really sustainable.
and perhaps elevates them from being seen as just a niche player into potentially a core holding for investors looking at network security. That's the long-term narrative they're trying to build.
One quarter at a time, it seems. Well, that wraps up our deep dive on the A10 Networks earnings call. Thanks for joining us.
Yeah, thanks everyone. Keep watching how this story of disciplined growth plays out in a pretty choppy tech market.
We'll talk to you next time on Talk Techers.
And one last time, remember this was all for informational and discussion purposes only.